over the past years, I've posted many videos explaining why I've stopped buying rental properties to buy REITs instead. In short, studies show that REITs on average earn higher returns than private real estate investments, and that's despite being safer and more passive investments. I'll put some of those studies on the screen and you'll see there that typically REITs outperform private real estate by 2 to 4% per year on average. And I would note that these studies only compare averages, but many individual REITs have done a lot better over the long run. As an example, self-storage REITs like Public Storage, Extra Space Storage and so on, the entire peer group has earned about 20% average annual total returns over the past 30 years. But what about today? Do I still prefer REITs as compared to rental properties in February of 2025? The answer is yes, and in today's video I'm going to explain to you why. Hey, this is YCHARTS. I run a small investment firm that specializes in REIT investing, and while today I'm mostly buying REITs, I come from a private equity real estate background. That's why I started my career, so I certainly understand the appeal of buying private real estate. I have myself invested in private real estate in the past. As an example, where I'm currently, it's a property that I own, but these days I prefer REITs, and there are two main reasons for this. So the first point I want to make here is that rental properties are today more expensive than ever. They've gained substantial value in recent years, and their rate of appreciation clearly isn't sustainable because home ownership has today already become unaffordable to the masses. And as a result of this appreciation, the initial yields, or also known as cap rates, for rental properties are today historically low, at just around 3 to 5% depending on the market. Making matters even worse, the cost of debt has surged significantly. Today, the average interest rate on the 30-year mortgage is over 7%, and this makes it impossible to self-finance properties with the use of a mortgage. The only exception would be if you're able to get a cap rate in excess of 7%, but that would be truly exceptional in today's market. You would likely need to buy a risky asset with a lot of hair in a bad neighborhood to make it work somehow, but that would be a very risky investment strategy. And so to recap what I just said here, rental properties are today historically expensive by most standards. They're offering low initial yields, and you can't finance them in a way that's cash flow positive. Because of that, many rental property investors have turned to buying properties all cash and then hoping to add a mortgage on them at a later date once interest rates return to lower levels. This allows them to get in the market, hoping to make up for the low initial yield with some appreciation down the line, especially if interest rates return to lower levels, and this is when they'll also be able to pull out some equity by putting a mortgage on the property. But how likely is it really that homes will keep appreciating further in today's market? Long term, they likely will, but right now housing is already the least affordable that has ever been, and transaction activity has dropped very significantly. So I wouldn't expect any significant appreciation in the coming years, and I don't think this is a controversial opinion. I think that this is what most people are thinking, and that's why no transactions are happening. Real estate is already very expensive, it has surged in value lately, and so I think it's much more likely that we'll see a small drop-off in valuation in the coming years, especially if interest rates remain at today's high levels. Okay, so let's compare that now to REITs. Despite real estate prices rising significantly over the past years, REITs are down by about 30% on average. REITs crashed following the surge in interest rates because it caused a lot of investors to pull out their capital from REITs to reinvest it in bonds. And that's one downside of being a liquid asset. It facilitates such rapid transactions, and clearly many investors weren't interested in owning REITs for the long run. Rather, they saw them as bond alternatives, but they then sold them at the first chance of getting a decent yield from fixed income investments. As a result of this, REITs are today priced at decade-low valuations, with many individual REITs trading at 30, 40 or even 50% discounts relative to the net asset values. These lower valuations explain why private equity real estate giants like Blackstone and Starwood have been buying a lot of REITs lately. Real estate is today a lot cheaper in the public market than in the private market, and it doesn't make sense to pay a premium to own a private, concentrated, work-intensive, illiquid asset with potential liability issues when you could get at a discount a public, liquid, diversified, passive investment. But REITs also offer another major benefit. Not only are they cheaper, but they also give you access to debt at a much lower cost. See, when you're buying shares of a REIT, you're providing equity to it, and the REIT then adds debt on top of it. This means that your equity enjoys the same benefit of leverage as if you were buying a rental property. The difference is that most REITs took mortgages years ago when interest rates were much lower, and they locked their rates for a long time to come. To give you an example, NNN REIT has an average remaining debt term of 12 years on average, and its average interest rate is just about 4%. Therefore, by investing in the equity of NNN REIT, you also get to benefit from its lower interest rates. It's the same as if you were buying a property in the private market and assuming it's debt at the same time. If the debt has a low interest rate that's locked in for a long time to come, this would typically increase the value of the property. But in the case of REIT, the market is not giving them any premium. On the contrary, it's pricing them at a discount, as we explained earlier. So to recap, REITs today allow you to buy real estate at a discount with the added benefits of lower interest rates. And so with that in mind, why would you buy a rental property in today's market? It just doesn't make any sense to me. But if you're still not convinced, take a look at this chart. It shows you that REITs have historically been especially rewarding after periods like today when they were heavily discounted relative to the value of the real estate they own. The chart shows that they have historically nearly doubled investor money in the next 3 years as they eventually recover. I think that today many individual REITs offer similar return prospects in the coming years as they eventually recover from their 3-year-long bear market. And what's the catalyst for this? I think it's a combination of two things. Firstly, rent growth will accelerate in 2026 as new supplies drops off significantly, and secondly, this will happen right as interest rate will likely be cut down further. I think that the combination of these two catalysts could significantly boost the market sentiment of the REIT sector, and we predict that will lead to significant upside across the board. Some REITs will of course rise more than others, and this is why you need to be very selective. At High Yield Landlord, our core portfolio only holds about 20 REITs out of over 200 in the US, and it is by being selective that we've managed to outperform over the long run. If you think that the topic of REITs is interesting and you want to explore the possibility of potentially investing in them, I want to invite you for a 2-week free trial at High Yield Landlord. This will give you immediate access to my own personal portfolio. This is a real money portfolio. I share all my positions with you in real time. I'll also share all my transactions with you, my exclusive research, including a lot of exclusive CEO interviews, all of it for free for 2 weeks. All you have to do is sign up using the link in the description of this video. Thank you very much for your interest. Let me know if you have any questions in the comment section below. See you at my next one. Bye-bye.